And the conversation continues looking at the macro environment. When you are taking the view from 30,000 feet now, that view is frequently clouded by geopolitical tensions and uncertainties, domestic politics, and also what the economist calls homeland economics, a resurgence of me-first mercantilism that is undermining the global framework of free trade that took decades to establish. But to help us make sense of this and to blow away the clouds, we have an able panel to do so. It is going to be led today by our moderator, Julia Leung, the Chief Executive of the Securities and Futures Commission, if you'd like to join us. She is going to be joined on stage by Mike Gitlin, who is the President and CEO of the Capital Group. Here they come. And Richards, the CEO. Sure, let's hear it for them. Thank you very much, Mr. Chan. Ann Richards, the CEO of Fidelity International. We have Andrew Schlossberg, the President and CEO of Invesco, and Mark Wiedman, the Head of Global Client Business for BlackRock. And as they take their places, ladies and gentlemen, they're ready for action. And Julia, the stage is yours. Thank you.
Thank you. Thank you. I'll go straight into the panel discussion because we only have 45 minutes. I wish to leave some time for questions from the floor. You've heard me and welcoming remarks, ticking off some of these mega forces which are have a huge impact on your investment landscape. I'm a supervisor, so I don't envy you with like tens of trillions of money at your for deploying in a way which will generate that return. And yesterday, I've been dying to go to this panel because yesterday, we've heard from a panel of asset managers and bankers. They tend to think that asset management is the next risk. I mean, the non-bank is the next risk. So here we are talking 30,000 feet, looking at the macro landscape, and we have all the geopolitics, the high interest rates. You are the money managers on the ground deciding each and every day where to put that money. So I would just ask a common question to all of my panelists, which is like, what in the last 2 years was surprising in the mega forces? What is surprising, and what really makes you think hard about where to put the money? So shall I start with Mike?
Sure, thank you. And thank you for having us. We appreciate it. I think what we've learned over the last few years is that you have to be wary of consensus. So if you think back to the last few years, we had lower for longer, which has now become higher for longer. We had, and I think we have to challenge consensus as well. And so for higher for longer, we have a whole generation now of finance investment professionals who only grew up in what I would call a more abnormal period. So if you look for the last 25 years, this group has seen the dot-com burst. They saw the global financial crisis. They saw quantitative easing. They saw supply chains close with COVID. And all through that, they don't really know what normal looks like. There was one 5-6 year period of what I would refer to as normal as it relates to interest rates, and that was after the dot-com and before the GFC. You had the 10-year US Treasury yield between 3.5% and 5.5% for 6 years. Outside of that, it's been very abnormal. It is abnormal. Just 3 years ago, we still had $18 trillion of negative yielding debt. That is definitely abnormal. And so when we look forward, and if you look from 1958 until the global financial crisis, the average 10-year Treasury yield was 4.75% when inflation was around 2 to 2.5%. So where are we now? Well, the 10-year US Treasury yield is somewhere around that average, and maybe we have a period that looks a little bit more normal, and we don't have to identify necessarily the next crisis, but get settled into a period of time that doesn't have dramatic extremes. And the only other thing I'd say is this concept of deglobalization I would challenge as well. I think of it more as reglobalization. And if COVID and geopolitics taught people anything, it was diversification of supply chains. Everyone in the world is doing that. That doesn't necessarily mean massive reshoring. It means finding other places where you can find partners around the world. So I think we're a little negative on the deglobalization concept. It's more diversification and reglobalization.
I like contrarian views. I think yesterday Vice Premier He also told us to make new friends. So you're actually on the same theme. But yesterday we heard that there's no alpha in public market. So are we seeing the asset management industry coming to a growth bottleneck in terms of AUM and profits over the next few years? So what is your strategy? You're very good in contrarian the views, but what is your strategy in creating value for your customers?
Yeah, the panels yesterday were fantastic, by the way. That doesn't mean every single fact you heard was true. And so I want to debunk some fake news that you heard yesterday. In the alternative credit space, there is a mindset that public credit can't generate alpha. So if you look at and this is not a Capital Group pitch, but it's a fact. If you look at our 10-year public credit, this is investment grade credit, our team has generated 97 basis points annualized of excess return through 2022. And so that is almost 100 basis points of excess return in the public credit markets. So just because someone says something doesn't mean it's true. That is a fact. And so I think it's important to know that facts are critical, and our team is able to do that in equities and in fixed income. And there are plenty of managers who are active who can generate alpha and not just beta.
Yeah, well, that is true. I will reduce your advertising time for Capital Group.
Can I add a comment, though?
Andrew, yes.
So just to pick up on what Mike said, so he's not a lone voice here. I think the issue is not active or passive. It's both, and privates and publics, and I think it's both. I think our biggest issue is there's too much cash on the sidelines, and what are we going to do to bring it back into the marketplace?
Thanks. Anne, what is your take on the macro forces? And you've heard the global bank, one of the global bankers was saying that the next crisis is in the non-bank.
Shock horror, bank says next crisis isn't going to be in banks. I mean, you know, I don't think that surprises anyone. So look, I'm going to pick up on something that Mike said, and in terms of what is normal, where do we find normal? And I think there's, just to be a little contrarian, I think there are two things which have changed. One is global demographics, and I do not think our economic models have yet got to grips with the fact that the global demographic and the shape of the global demographic over the next 20 years is going to be very different from the one over the last 20, 30, 40 years. How does that feed through into demand side, all of that kind of thing? I don't think we have got anywhere close to getting to the bottom of that. So I think that is something that is different. What that means, whether that's inflationary or deflationary, find me two economists, I'll find you three views, but nonetheless, I think that is something that we need to really factor in as we go forward. I think the other thing that has changed meaningfully over the last 20 years or so is the interaction between fiscal and monetary policy. And I think you've seen governments leaving much, much more to central bankers to sort out, with consequences for their own finances. And again, how that plays out, I think, is going to be quite different going forward. And I think there are some quite tough choices that have to be made, which will then have ramifications for what the investment horizon looks like. But then to sort of pull it back into specifically what the implications are for our industry, if you think about what we try to do, we try to provide the bridge between the underlying growth that comes through corporates, whether it's through their debt, whether it's through their equity, but that attachment to the real economy. And we try and marry that to what individuals, whether that's through an institution or directly, to what their aspirations and needs are for their whole of life savings, whole of life investments from cradle through to grave. We try and be that bridge between the real economy and what individuals need over and above what they gain day to day when they work. And so if you think about that as the purpose for our industry, yeah, we have to adapt, we have to change to what is going on in the real economy, and we have to reflect that. But fundamentally, that is what our industry is there to do to be that bridge. And whether you do that through a mutual fund wrapper, an ETF wrapper, whether you do that through active, through passive, through debt, through equity, fundamentally, we are the glue on the connectivity between what is going on in the real world and the long-term wealth aspiration, retirement savings of the population at large. So we have to keep adapting what we do and shaping what we do to what is going on in the real economy. And I think that that is the challenge for us, but it's also the opportunity for us.
Just a quick follow-up question. As you talk about there is more integration or marrying of your monetary tools with your fiscal tools, but now that with it looks like the lowering interest rates, which had been the formula in the last 20 years to solve a crisis, is no longer there because of inflation. So going forward, do you think that we are able, I mean, your ability to reflect on these real economy and provide what is needed, how do you think that interest rates and how long, I mean, how transient or how permanent would these high interest rates be?
So I think what you have seen is that the transmission mechanism, and particularly in the US, has acted with far less speed than has historically been the case. So the inflation was much slower to respond to a higher interest rate environment, and actually growth, activity was slower to respond, particularly in the US. Actually, it's worked a bit better, probably in Europe than it has in the US, but then the banking sector still has a greater role, for the reasons we heard yesterday, in the transmission mechanism in Europe. So I think it has been slower, but I think we would argue that the transmission mechanism hasn't in itself been broken. It's just been pushing on a piece of string rather than pulling on a piece of string. But ultimately, we have succeeded in moving it a little bit. If you look at the most recent data, you can sort of see finally the transmission mechanism is working, inflation is beginning to move. So I think that it is still there, but in this environment, particularly as you head into the political cycle that we are going into, I think it's going to make central banks globally, but also in the US, wary about doing anything too suddenly on anything. So I think this year will be a year of cautious policy, which probably does mean higher for longer, but with less likelihood of big jumps in either direction. I think that is probably because of that cautiousness in an election year.
Yes, of course, a vote of confidence in our central bankers. Andrew, back to you. You mentioned cash. There's a lot of cash on the sidelines. So what is it that you're doing with it?
Well, I did mention cash on the sidelines, and we represent shareholders around the world, so maybe I'll just comment what they're telling us rather than what we're doing with the cash. And this is more wealth management, wealth advisors, individual investors around the world, in particular in the developed markets. Something like a third to a quarter of their portfolio is in cash or cash-like instruments. And for the reasons Mike and Ann were both already covering, the interest rate picture is one of them. But I think the comment I wanted to make was more around the geopolitics. And I think picking up on what Ann said, I think one of the greatest challenges we're seeing is the tensions, wars around the world is really playing on the psychology, we think, of individual and wealth advisors. And so not only does the interest rate picture probably need to get more clear, but also I think the political environment, which is going to be difficult. So what we're seeing is portfolios are really positioned in a pretty defensive way, and what it's going to take to get them off the sidelines isn't just interest rate policy, but really, I think, sentiment and psychology.
Taking both Anne and Andrew, it seems like it's your psychology. It's how we think about the global outlook that matters, and you're just the intermediary trying to deliver.
Well, I don't know, Anne, if you want to. Well, of course, we have our own positions. It's their money, and what they're doing with their money is staying in cash, and they're getting paid to stay in cash. And so what's the catalyst moment that's going to create for them to look at riskier assets? And that'll probably come first in the private and public credit markets. And picking up on what Mike said, it's both sides of that market. But really, they're looking for the catalyst moment. And it may be interest rate policy, but it's probably not political certainty over the next year.
All right, so waiting for that catalyst. So Mark, so what's your take? What is BlackRock's take on what's on this 30,000 feet and what is changing here?
First, I want to say thank you for having us here. Thank you for this amazing conference, and also thank you for the privilege of operating here in Hong Kong. So I'm going to try to scale. Julia, in your speech up front, you actually anticipated all the big forces that we think are driving the economy. So I won't repeat them. What I'll try to do actually is put numbers on them, as to actually what matters for investors. And there are 4 regime changes that we think about at BlackRock that are actually driving where global capital is flowing. And when I say global capital, I'm really talking about the West and Japan. China is a very different story, totally different monetary regime, different trajectory. The first one is interest rates. There's about $4 trillion of cash that is sloshing around waiting for action. Now, when that happens is open for discussion. Peter Harrison yesterday talked about how long these cycles tend to work through. I think if you watch public markets, you get complacent that action happens quickly, but the reality is the real economy adjusts when you have to refinance. And so we don't know when that cash will come back in, but that is the first big overhang that clients talk to us all the time. The second big driver is we see is the transition to a low carbon economy. And right now, the world invests about $2 trillion a year in energy of all various forms. That number, we think, is going to go to about $3.5 trillion, and the mix will shift from about 60% green-oriented, renewable-oriented, to about 80%. So we're talking about roughly $2 trillion of incremental investment in the transition. That is a perfect pairing. Most of those are very long-dated cash flows. For example, the electricity you earn on your solar panels. Long-dated cash flows that marry very nicely with pension and insurance assets. And yesterday we heard correctly that the public markets are short on long-duration spread assets. So that's very attractive. The third one is Basel III, and this is what drives the growth of credit, is actually the shrinkage of banks. Western banks. We're not really talking about Japan or Asian banks. And the reason is Japan credit demand is very, very low, and there's actually plenty of capital in the Asian banks. But in the West, what we're going to see is $4 trillion, we estimate, is coming off of bank balance sheets over the next 5 years. It'll come off in the form of loan sales or securitizations. And that's going to end up in asset manager portfolios and ultimately in the hands of pensions, insurance companies, and wealth. So that's about $4 trillion, call it $800 billion a year. And then there's a lot of talk about, as we have been talking about, supply chains and geopolitical tensions. In terms of investments, not what's interesting to talk about, but investments, this is a much smaller number. Our guess is we're talking about $300 billion a year of capital moving. And the reality is, as a public investor, it's quite difficult to invest in Vietnamese or Indonesian or even northern Mexican infrastructure, which is where a lot of that capital is flowing. So actually, if we were thinking where to pay your attention, it would start off with, when does the cash come off the sidelines, as you were just saying, Andrew? It's about the transition to a low-carbon economy, which is a long-term secular shift, very capital-intensive. And then third, this 10% shrinkage of bank balance sheets that we anticipate in the West.
So, so both Mark and Andrew has talked about the cash and the cash on the sidelines. So and this $4 trillion that's waiting to be deployed once the catalyst moment comes. So Mike, I want to ask this question. We've seen during the pandemic when interest rates were zero, investors would plow into tech and alternatives and private sector that you talk about. So now that we are nearing the interest rate cycle, the hiking cycle is nearing an end, how do you expect the alternatives, the private market to grow, or the tech stocks, which should be hit suffered more from the high interest rates? Is it going to be the same more of this trend or other?
Yeah, when you look at the market, I think what people want to do is two things. They want to stay invested and they want to get the big things right. And so when I look at interest rates, and I think this is a really interesting conversation, I agree with Mark, when you want to own bonds is at the end of a hiking cycle. So the window really opens from the last hike to the first cut is the window of opportunity in bonds. And the big move is the 500 basis points plus of hikes we've already seen. Trying to be smart on the last 25 basis points of hikes isn't a good business to be in. So trying to get the big moves right. What hurt people in 2022 wasn't credit, it was owning duration, because rates went up so fast. If you look at the forward market, the market predicts the Fed to cut by 75 basis points over the next 13 months. I don't know if that will be right or wrong. But the market thinks we're relatively close to the peak in developed market central bank hikes. If that is true and yields are high, you have an opportunity now to own bonds at 6, 7, 8%. Very similar, I'm guessing, to most people's long-term capital market assumptions for equities. So I do think that window's open, and I think that's an opportunity. I think the public-private debate, I'm not sure it's as much of a debate as trying to find an opportunity and how much you're willing to give up for higher expenses and illiquidity. And there's just going to be a portfolio construction impact to that. So you can't look at them in isolation. I think you have to think of these things in terms of portfolio construction, whether it's active management, passive management, alternatives. How do you think of a broad portfolio solution, and what's the liquidity profile of that portfolio, rather than an either-or conversation?
Right. You touch on passive and active. Now, Andrew, yesterday we heard that the passive, I mean, don't know, this is one of Mike's comments, whether this piece of fact is true or not. Passives now account for like 40% of the turnover. And because of, and 10 MSCI stocks in the US account for the bulk of the market capitalization. But I think I've read somewhere that you have remarked that given the rise of passive, Andrew, then the industry is oversupplied with products and capabilities. So is that a view that you will, going forward, do we have that oversupply? And what do we do about that?
Look, I think we do. As an asset management industry, we have twice as many products for the retail and wealth space in the last 20 years than we have in the US 60% of the stocks. So something about that means we might be oversupplied to product. But I think it's more the emphasis, it's less on a passive active discussion. I think it's the emphasis on quality. And everybody here on the stage will talk about investment quality. And it's why we're especially happy to be here with this group, because everybody here is about investment quality. And it's also about longevity and taking long-term positions, making short-term fluctuations, but long-term decisions. The only thing I'd add to what was commented on yesterday, because the narrowness of the markets, whether it's 10 stocks in the equity markets, or it's people invested in their domestic economy only, or they're just in cash securities, is that the markets are way too narrow and concentration is way too high. And so I think there's plenty of product for people to go into. I think the work we need to do going forward as an asset management group, I think, and certainly as Invesco, is to make sure that we have high quality products. And I think something maybe we can talk about later, that we're set up for more personalization. So less packaged product and more people able to express their points of view in portfolios. I
think I've heard a familiar theme through all the speakers, that it's not passive versus active, it's not choosing one against the other, it's your choice, it's your prospect. But I would make it more pointed to Mark. How do you make, I mean, the audience in this room are dying to hear what's the next 3 things that you think that would be yield, that would provide the yields, which is better than bank deposits. So tell us.
Well, first, actually, you're part of one of the struggles that banks have is that the spread income that were addicted to when you could pay 0 basically and lend out at something is being compressed. There was a nice, lovely window where banks were able to pay 0 to depositors and earn like 4%, 5% on risk-free assets. And that's over now. And so the average deposit in the US, for example, has already gone up to 3. In Europe, a little slower because there's less competition from money market funds. But eventually that tension will lead to effectively NIM compression. I think what's interesting going forward in terms of long-term yield, Okay, I actually agree with Mike that the long-term, that picking exactly when to leg into long-term assets and particularly spread assets, that's a difficult game. But if you liked bonds, or even if you didn't like bonds back in 2019, you got to love them now, because they actually, like, you can earn on the risk-free assets, you're earning a real return of 2.5%, and then from there you can just stack on that with credit. So now is a golden age for getting back into long-duration assets. Depending on your preferences, you decide whether to do it now or in the future, but that's going to be a bigger part of our portfolios going forward than not. The other big parts are private credit. I think whether it's insurance companies or individuals, that extra spread, assuming they can either match their liabilities or handle the illiquidity risk, that's another very attractive area. And then infrastructure. The world needs huge sums of infrastructure. I mentioned the transition, that's $1.5 trillion extra per year, but it's also aging societies, as Anne mentioned. All large economies are facing fiscal constraints. Everybody is going to have a problem with not enough workers relative to retirees. So the state is going to have a fiscal constraint on how much it can fund in infrastructure. There's only one place that can come from, which is actually from long-dated investors. So those are the areas we'd go. Bonds, especially with credit, private credit, and then infrastructure.
Good, a good list. And I'd like to turn to you for management skills. Now, as we said, we are seeing reversals of multi-decades trends. And you've written in an FT article, to maximize the chances of survival in a storm, 3 things are needed: a well-drilled crew in a seaworthy boat, enough life jackets for everyone on board, and the ability to swim very fast to the shore. Now, although you're talking about fintech firm, clearly, but I believe that asset managers also needs to translate that into, I said it all the time to the industry, risk management, contingency planning, agility. So can you talk a bit about how, through these forces and changing in forces across Fidelity International, and what are the implications on the management skills, and what kind of people do you, how do you teach them? Particularly when some of you were talking about they've gone through an era in which is low interest rates. How do you retune them into this new world?
Well, I think actually this is one of the most fascinating topics for all of us who invest in markets. And if you look at, before I specifically come back to Fidelity, just actually thinking about the businesses that we invest in and what we've been seeing, particularly out of the US. If you look at the earnings season this year, it's come through really strongly. Management teams in the last 5 years have been through an unbelievable storm where they have had to redesign, retool, reimagine entire supply chains, entire workforce practices. Who knew that we could put global workforces in dozens of countries simultaneously into a working from home environment and keep our businesses going, keep the businesses that we invest in going, by the way, who've done the same. So I think you have management teams who have been kind of honed in a furnace to highly tempered steel. I'm probably mixing analogies horrendously at the moment, but you kind of get that. And I think you've seen it come through in corporate results. So don't underestimate the power of management who've been through a lot, actually. Their ability to pivot, to be agile, to reimagine stuff is probably better at this moment in time in just about every industry to any other time in history, because it's had to be. So when you then sort of pull back, what does that mean within our industry and within our business in particular? Asset management is a peculiar business because we have almost no pricing power at the revenue level. You try talking to a client about lifting fees, right? Not a conversation. You go into a supermarket, they lift fees prices all the time. Really hard for that to happen in an asset management world. We rely on markets to progress, for our fees to increase, and yet our costs are very much baked in and are very much aligned to what's going on in the wider environment, because typically in our business, half or so of our costs will be people related, and those costs tend to move with the broader market pressures on pay. So in a low inflation environment with low interest rates and rising markets, that's kind of a sweet spot for asset managers. The environment over the last 3 years or so has been radically different. So we have to go through that retooling, that reimagining of all of the foundational pieces in our organization. We have to strip out layers in a way that we've never had to think about before. So we have to think of ourselves increasingly as first and foremost, as a data business. We have to think end to end in the processes that underpin that. So the investment that we are putting in a ton of that foundational stuff around data, around technology, is larger than it's ever been, and by orders of magnitude. And then similarly, our people, we have to get them comfortable with the ambiguity of the environment that we're operating in. People have to be comfortable with change, and that ability to pivot is something that we constantly reinforce internally. So it's kind of a combination of simplifying processes, getting the foundational piece right, and at the same time getting the psychology and the headspace right to be able to keep responding without getting fatigued to this very strange world, this new paradigm that we're all working in. And it's intellectually interesting, but it's not easy.
Any one of the our panelists would like to share their view on management?
Mike's got a new job.
Thank you, Mark. I appreciate that. So the one thing I would say, Anne's absolutely right. We do not control our revenue. There's a certain beta element to our revenue related to markets. We do control our expenses. And if you have the privilege to work at a private company, not a Capital Group commercial, just private public. If you have the privilege to work at a private company, you have to push yourselves to manage for the long term and not get into the cycles of management that you have to do as a public company. So when people evaluate your quarterly earnings as a public company, you'd prefer to meet estimates than not. When you're private, you have to say, where are our greatest opportunities that we're starving because of the current environment? And then push yourselves to invest in them so when you come out the other cycle, you've made progress. And that's something, it's hard to do in the moment, but you always, you benefit from it long term if you're able to do that. The other thing you asked about was about leaders. I think leadership is very important in all times, but certainly during volatile times. You want leaders who do two things very well: listen and learn. And Eddie does that very well. And HKMA, if you look at HKMA from 38 billion to 450 billion over 30 years, they've adapted. So you have to adapt and you have to listen and learn and get better. And I think that's important for any leadership group, wherever you are.
You're very good at advertising for HKMA as well.
Can I yeah. Maybe just to add to Anne's comment on leadership, that was well said. The only thing I'd add is we all run global businesses here. And so I'd say the global connectivity, which over the last several years was challenging, and it is why, and thank you to the Hong Kong Monetary Authority for hosting us. It's why getting back together and re-engaging is important, and I think it's one of the things that got lost during the pandemic, obviously. So resilience is built over time, so is trust and teamwork. And being able to see up close and personal both our teams, but also the global economy and the global markets like we are today is really important.
Yes, Mark?
I just wanted, hi. Actually, regarding leadership, I would recommend, if you haven't seen the panel yesterday from past and present HKMA leaders, it was a session. I actually was talking to Hendrik de Toit, who runs 91, about how showing this to our teams about institution building and vision over time. So that for me was the most inspiring panel from yesterday. I actually take a slightly darker view of the industry than Anne does. So to mix it up a bit, I think our industry has been sedated for 15 years by cheap money and 40 years of ever-declining rates. Anybody who levered up with term financing looked like a genius over that 40-year cycle. You didn't have to do much. That's over. And I think that level of complacency is very difficult for organizations to shake absent a shock, and they haven't really faced a shock. I thought it was coming in March and April of 20 when equity markets were collapsing. I was like, uh-oh, here comes the overcapacity, it's coming out. Nope, we got that bailout. So I think we still struggle with that in all of our organizations. I know even, I've been reading Only the Paranoid Survive by Andy Grove again, and there's a passage in there where he talks about when Intel was facing the demise of memory chips. And he and his partner are saying, well, what would a new management team come in and do? They would say, we'd get out of memories. Why don't we do that ourselves? And I think that's something that every management team in the asset management world needs to, particularly in public markets, needs to be thinking, what is going to work for the next 20 years? Because it's probably not the stupor and the drug we got for the last 40 years of central bank pumping up of assets. Too bad. That was great, but it's over.
I love you, the way that you describe it. The central bank drugging you and sedating the industry. Right. Now, my question list is blinking and blinking, so our audience are actually had quite a lot of questions. I will take one from here, and if anybody is ready for the next one, I'll take the next one from the floor. This first one is, actually is named, so I will say, so it's real. So it's John Orchard from OMFIF. How worried are you about the US fiscal position and its debt sustainability? And what impact on the sovereign bond market and currency would you expect? So this is a timely question for November where there's a deadline for the debt ceiling. So who would like to take this? And is based in London.
You can't ask the one person not based in the US to answer this question, folks. Come on, get real.
It makes it far more credible.
I'll take it.
Mark.
Very quickly, the fiscal unsustainability of the US right now is not priced into markets, and no one's really paying attention to it. And one morning, people are going to wake up and decide this is one of the most important forces in global capital markets. I don't know what will trigger it. It'll be something. And at that time, it won't be a funding problem. The US government can fund in perpetuity. There are plenty of buyers out there who will buy treasuries. The issue is that it will reprice global capital. So yields will rise, and every asset in the world will be repriced. When that happens, I don't know.
Yeah, the other thing I would add to that is I talked about a generation of investors who are accustomed to the abnormal, not the normal. There's also a generation of investors who are predominantly dollar-based investors in their mindset. And I think we talked about diversification of supply chains and the concept of reglobalization. There's also diversification in currency. And I think there's an opportunity for the dollar-based investors to get non-dollar exposure. So I think you'll see more of that. The dollar was a one-trick pony in financial markets for a very long period of time. Having exposure to non-dollar either through global bonds or global stocks or trying to find a way to get that, I think will be a good thing as you look at any country's fiscal policy.
I'm just going to add one thing to that, which is, and going back really to what Mark said, which is a very important point. When you're the world's reserve currency, when you're the world's risk-free asset, I put that in quotes, the other side of that coin is it means you do rely on the kindness of strangers. And I think sometimes the US forgets that it relies on the kindness of strangers to keep the investment flows flowing towards its key markets in the way that it likes. And so I think Mark's point is absolutely right. There is a moment, if the US doesn't build that into policy, that there will be chickens coming home to roost. Yet another metaphor for you.
Andrew, you have anything?
I'll let Anne have the last word.
Always good to have a woman have the last word. Right. Any questions from the floor that would take precedence? Yes, please, this gentleman in the middle.
Hi, it's Freddie from Invesco. So this question is not for Invesco, but I would say hearing a lot all your leaders highlighting a lot of macro landscape, but we haven't talked about China. So a lot of global firms are actually finding difficulties to navigate the game plan in China. So how do you define your own firm's success operating in China? in the long run. So, anyone?
Maybe start with Mark. You have a China presence.
Okay, multiple of us have China presence.
Yes.
It's the second largest capital market in the world. Maybe one day it's the first. Long term has to be part of a global investor's portfolio. We also think there is a massive policy-driven shift in China to diversify people's retirement savings, which today are basically real estate and deposits, and in the future need to be more capital markets driven. So long term, those are big opportunities for us. Cyclically, this is a difficult time in China. Investment confidence domestically, I think people talk about China like US-China tensions are the driver. It's domestic policy, domestic investments are the driver of what we see as the long-term opportunities in China. Right now, cyclical challenges, but long-term, all of us, everyone understands that this is a central part of the global economy and global markets.
Mike?
Well, I think from an investment perspective, I always like it when you hear Fed speak and then people spend hundreds and hundreds of hours trying to determine what the Fed just say, and I always say what they just said. And so in China, if you're looking for long-term investing in terms of long-term policy makes sense. China economy is undergoing a massive transition that will take decades. And it's one from export-driven fiscal stimulus, land and property, to domestic consumption, domestic innovation, technology, energy transition. That, in an $18 trillion economy, that takes time. But if you're leaning into where the policy's going, you'll have a better opportunity to benefit from investing in those areas.
Anne, you want to add anything to it?
Well, I'd just say that I think when you look at the landscape, China and the Chinese economy is such a key part of the global economy. That is not going to end anytime soon. It's a key part of global supply chains. It's a key part of what keeps global capital flowing around the world. And therefore, I think a healthy Chinese economy is extremely important to the health of the global economy, to the growth of the global economy. I think the policy measures that were talked about yesterday, that we heard about, I think are important. I think the policymakers have been taking a very thoughtful approach to dealing with some of the imbalances that have grown up in the economy. But when you look forward, when you look at those global challenges around the climate, for example, China is absolutely a key part of the global solution to that. And I think that's what we stay focused on, in addition to the fact that in a market of 1.3 billion people with clear savings need for the long term, that is also part of where the flow of capital comes from to fund many of the other things that we need to make sure happens to keep the planet safe.
Am I allowed to make a comment? Yes. But I would just say I echo all the comments made, and China can't be ignored. And putting China's markets aside for the moment, I think, Anne, you were mentioning the quality of US companies through the last period of time. Seeing the quality of Chinese companies and the strengthening of Chinese companies to create more investable opportunities domestically and globally is going to occur. And so it can't be ignored, and the strengthening of the capital markets and the quality of the companies is going to create amazing opportunities.
Right. Any more questions from the floor? Here. Thank you.
Do you also work at Invesco?
Hi, I'm Jackie. I have a question. The Fidelity and BlackRock also apply for support Bitcoin ETF from US SEC. Hong Kong is also the blockchain center in Asia. Will you invest more and cooperate in Hong Kong in the future? Thank you.
Here the question is the US regulatory environment for Bitcoin and cryptocurrency a bit different from that in Hong Kong. Here we have a regulatory regime, very clear guidelines. This is where I do my advertisement. Very clear guidelines on how to a centralized platform as well as intermediaries, fund managers like yourself in when you are dealing or when you are structuring a VA fund. So the question is whether, do you see that the client interest and whether Asia, Hong Kong is the place where you can pilot with some of these investments?
I'm happy to take that. So I think it's fascinating, and I think you have to separate crypto in its very narrowest form with what blockchain and distributed ledger technology can do underneath it. And obviously we have heard comments even this morning from Mr. Secretary about what the aspiration is for Hong Kong to do there. I think regulatory environments around the world, Switzerland, Singapore, the US, the UK, elsewhere, are wrestling with what is the right framework and what is the right toolkit to encourage innovation in this whole area, but without exposing consumers to inappropriate risk. And I don't think anyone has found perfection there yet, but I think this increased use of pilots, of sandboxes, of trying different things to work out which parts of the ecosystem get traction and then can be rolled out into scalable. I feel we're pretty close to the tipping point, and I think Hong Kong has a part to play in this, as do other jurisdictions. Nobody yet has won this. I think it's all there to play for.
If you don't want women to have the last word, Andrew, you can, or any of the men.
I'm going to say no again.
All right, very gentlemanly. The countdown is 0, so we're right on mark. So thank you. Let us give a round of applause to our distinguished speakers.